So this session is now intended to take a look at it from the CEO and the CIO level, so the person who's been charged with implementing a strategy and an organisational response, and to take the opportunity to then go down an additional level and look at how, from a whole of organisational response, institutional investors are actually dealing with climate change issues. And I'm really pleased with the panel that we have today in terms of the different set of issues and the different types of investors that we have to go through and to unpack some of the issues. So I'll just quickly introduce the panel. So starting on my right is Damien Frawley, who's the CEO of Queensland Investment Corporation, or QIC. Then we have Corin Colcott, who's the CIO of BT Financial Group. And then we have Sonia Sawtelle-Rickson, who's the CIO of HESTA. And joining us shortly will be Richard Brandweiner, the CEO of Pendal Group as well. So who's literally running up the escalator as we speak. Literally running into the room as we speak. So please welcome to the stage, Richard. That was perfect timing, Richard. I was literally just introduced you. Fantastic. All right, so this is going to be a fairly free-flowing conversation, and I'm really keen, as you can tell, free-flowing, not freewheeling, that I'm really keen that we take the opportunity to actually talk about the whole of organisation response. So what I want to do is I want to start with each of the panel members in terms of asking, how is your organisation, what's your approach to dealing with climate change? How is your organisation currently thinking about the issues and responding to the issues? And so I'm going to start with Sonia, and then we might work our way back down this end of the panel.
Wonderful. So I work with HESTA, and at HESTA we've got a long history in responsible investment. We're the super fund for the health and community services sector, so I think there's been a very strong RI and social justice bent in the fund since inception. But that level of RI integration and sophistication has definitely evolved over that 30-year journey to the most recent iteration, which is really the way we position our approach to responsible investment is as HESTA Impact. And for us, HESTA Impact is recognising that our approach isn't just about responsible investment in the investment arm anymore, which obviously as CIO is where I spend a lot of time, but it's about how we invest our capital. It's about how we advocate in the market and use our voice on behalf of our members. And it's also about how we act as a corporation and our corporate sustainability approach. Recognising the importance of this, we've recently established a new board committee. So we now have a HESTA Impact board committee. And their job really is to oversee the limbs of that strategy and make sure that we're clear on our ambitions and that we are delivering against those ambitions as we move forward.
Great, thanks, Sonia. Corin.
Thank you. Probably to put in context, I report to two boards, so there's a super board and there's a non-super board, and the $45 billion that we are responsible for investing is done through a manager structure. So ESG falls under both boards' investment philosophy and beliefs, and that's where the climate change piece resides, and that is done as a joint board effort, and so that makes things a little more easier for me. In terms of how the approach we go through the strategy is four pillars. There's one where taking into consideration ESG risks and opportunities is embedded in the manager due diligence process and requirements that we have in our investment management agreements with the likes of Pendal, for example, who is one of our managers. The second approach is an engagement model that we've been hearing about. We use the services of both Regnan and Hermes to do in that. Third is an exclusions policy, which, like we were hearing earlier on, where you fail to get results with engagement, we then have another avenue to go down. We don't have anything in climate change and exclusion policy at the moment. And the third is also advocacy, where we belong to a number of different groups.
Great, okay. Richard.
Thanks. Hi. Yeah, Pendal Group, I guess. So we're an active fund manager, and there are really three areas where I suppose sort of encapsulates how we tackle these challenges. And the first is the recognition that we believe that stewardship and active ownership is very much at the core of what active management really needs to be. And so we are allocators of capital on behalf and together with our clients. And importantly, we have a very critical role in holding the management of companies into which we invest to account for the decisions that they make. And so as stewards of capital, what's critical is that we manage that capital in a way that is mindful of the impact of externalities on long-term earnings, and also the behaviours of companies and how they actually seek to create real long-term value over time. So we do that, of course, by judging companies, by evaluating them, by choosing to buy or sell, but also, of course, in engaging with them and trying to hold them to account. The second element, many of you would know, but not long ago we fully acquired an organisation called Regnan, which is a leader in ESG research and corporate engagement. And the reason why we did that was we felt that bringing that closer to our investment decision making and research capability was going to actually improve our ability to understand companies more holistically. And it was actually going to improve both our ability to evaluate companies that we want to invest in, but also for Regnan, who do engagement services on behalf of a number of asset owners and institutional investors, that for them to actually get a broader perspective on company strategy, quality of management, all these sorts of things was actually going to improve the way we did engagement on behalf of those clients as well. And then the final thing, Sonia mentioned too, we are a listed company. She's not a listed company, but the role of being a corporate citizen and how important that is. And so from our perspective, there's a little bit of a climate footprint that we have, but of course the bulk of the way as a corporate and as a citizen we need to exercise, our responsibilities is through the investments that we make.
Great, thanks. And Damien?
So those of you who know QIC is an interesting organisation insofar as it's government owned, so you can probably imagine that adds a layer of complexity to my day job, managing the interests of the shareholder, but most importantly managing the interests of our clients, of which some are large pots of government capital. But also more recently we have a very substantial book of third party, as we call them, clients from around the world. So that gives rise to, as I said before, some challenges and complexity around how we think through the topic of ESG more broadly. We try to rise above the political debate and discussion as best we can, because that is important that we do that. We don't want to be sort of pushed in one direction or the other. Our starting point is always, we act as a fiduciary on behalf of all of the money that we manage, and making sure that we, are looking to actively manage the assets that we are the custodian of, and that we are trying to generate a return out of. And I think Richard made the point then about sort of active management, the importance of active management, and also being able to influence outcomes, particularly things like climate outcomes. And so our business consists of a very substantial book of public market securities, fixed income and equities, but more importantly the ones that we manage in-house of the private market asset classes of real estate, infrastructure and private equity. So we do have a high level of influence around active management of those assets, and that's effectively our clients see us, and that's frankly how we sort of justify the fee that we charge for those clients. So it's critical that we continue to manage those assets in a manner that are sensitive to the community that we operate in, but more importantly and that's not just the domestic or the local community, but the global community, and that's where clearly, climate change and the impacts of climate change on those assets occupies a lot of debate internally, because interestingly the previous panel, Stephen Dunn, thank God he isn't the chair of our investment committee, but Stephen sits on our board. Stephen does indeed, however, chair our ESG committee, and does a very, very good job of that. Stephen has a particular passion for this. The other interesting thing is that we also more recently have started to build out an ESG group internally with the appointment of a couple of highly talented professionals in that space. They clearly guide and direct the investment teams and work very closely with the investment teams to ensure that we are on that right path. But the other interesting thing and probably more important thing is that ESG, or that group, is embedded in our risk part of the business, because we do see it like any other risk that a fund manager needs to manage. It is a financial risk when you boil it all down. So credit risk, currency risk, all those sorts of risks. So Kate and her group sit within our risk group, our RGT group.
Damien, I wonder if I would just stick with you for a second, because I'm interested in, with all of the different investment firms, quite different footprints, but I'm really interested to understand from your organisational perspectives the drivers for adopting a climate change response. So what was the kind of the key sort of constituency that really kind of had the most impact in terms of determining your climate change strategy? Was it members? Is it your stakeholders? Is it external market conditions? Is it regulators? Was it, what was the kind of key driver in terms of how you're formulating your organisational response?
The simple answer is probably all of the above. But ultimately, when you boil it all down, it really is, we sort of stand behind when we make decisions on where we invest people's money. We are doing that on behalf of individuals, ultimately. That's when you think about what we do. I'm sure there's a super fund that sits between the fund manager and the member, but usually people like Sonia and other CIOs and CEOs of the large clients that we have, the super fund clients, including the government client, the big defined benefit plan, are pretty clear, and they're a pretty good read on the temperature of their members, I find, and there is a groundswell, I think, of activism in this space, not just by people marching down the street in Brisbane every second morning, or a young girl turning up at the UN in a boat. There's a bunch of other things, frankly, that are happening, and the members of these funds, I believe, want to see change and want to make sure that the managers that are managing their money ultimately are doing the right thing. So I think it's all of the above.
Sonia, did you also want to pick up on that?
Yeah, absolutely. I think for us it's definitely our members is where it started. As I said earlier, the health and community sector, so our member research for a long time has been showing this is one of the most important issues for them. So for us, it's been very much about how do we affect that and how do we take that forward. Our member reps on our board have been also very, very vocal and articulate about these challenges in terms of incorporating responsible investment. And so it actually led to HESTA making a public promise to our members, which is that we will be gutsy advocates driving meaningful change for generations to come, which is a very lofty statement. And for us, that means we basically want to see our capital not just generating strong financial performance and financial returns, but also having a positive impact on the economy, the environment and the society that our members will retire into. So that's very much what's been driving our strategy.
Karen, is that the same, from your perspective, key drivers in terms of the BT response?
I think, like everyone here, a bit closer to Damien, it's all of the above. But it does help that if you think about the vernacular in the space at the moment, seeing climate change as a financial risk, that being in the dialogue of regulators, that being enshrined in law, and the various rating agencies also requesting or basically requiring of trustees and directors to incorporate climate risks specifically, right? I think that has sped up the process. So at BT, ESG considerations and requirements for us to have managers explicitly report to us on how ESG and climate change risk, affects their decisions, has always been there, which is a bottom-up process. But having a top-down view, which is a little bit more like HESTA's, I think, is definitely on the forefront at the moment. So we're having explicit workshops with both our boards at the moment on climate change risk specifically, to see if there's more of a top-down approach that will also come to the fore.
Richard, I can see you're nodding. That's a good cue.
I was agreeing about, in particular, the change that's happened. I really, in the last 3 years, I'd say, perhaps even more recently. And if you think about, if you went to most fund managers 3 years ago and said, tell us about ESG, they would have said, oh, no, we don't need to, because we do it anyway. We do it as part of our research process, because we're looking at companies and we're trying to worry about what's material, and so don't worry about it. Which of course wasn't true, but that was the narrative. And what's happened, of course, is through various pressures that we've already talked about, but I think far more fundamental, just the groundswell shift in thinking, awareness and attitude that has happened, particularly around climate, but more broadly around externalities and footprints in the sand and all those sorts of things. I see, for example, when I speak to our fund managers, our investors, they are explicitly considering this particular environmental issue or this particular climate issue and what that's going to do to the earnings of that organisation. And that might have always been in the back of their minds before, but now it's definitely a bigger deal when it comes to evaluating a company, which I think is hugely beneficial. The other thing, of course, is that there is increasing demand from clients across the board for tailored strategies that might be specifically low carbon strategies, or they might be biased towards thematics around climate mitigation businesses or things that help with transition. So I think there is also a shift in actual explicit demand for more tailored thinking in this space.
Does this also change the kind of internal capabilities and resources that you build? I mean, also mentioning the growth of the team, the acquisition of groups like Regnan. Does the key driver for your organisation change the way in which you build capacity internally for your response as well?
I think everyone's got to wrestle with how do they get insight. In all these things that are now, because you think about it, of course, you've got this circular flow where consumer attitudes are changing, which actually then change consumer demand patterns, which then, of course, change earnings. And then on the other side, you've got demand and supply changing from asset owners and asset managers. So all these things coming together. To understand the implications of all that is non-trivial. And of course, climate, I mean, there's so much we don't know, and there's so much that's involved in forecasting and scenario analysis, etc., etc. So I think, we went down the path of internalising some of that capability, but of course there are many ways to try and access that insight that you need.
Sonia, I mean, internal capabilities and resources, does it change depending on what you see as the key drivers?
Yeah, I think so. We went through a process probably 18 months ago to really sit back and look at our responsible investment capability. And as I said, as part of this HESTA Impact strategy, realising that we needed to really pull in somebody to sit over the top with that advocacy arm as well, making sure that what we're doing for our responsible investment and our manager engagement and our underwriting was consistent with the advocacy work that we're doing, participation in organisations like IGCC, and also consistent with what we're doing in our procurement strategies and other things. So at that time, we established the team, moved it into the front office again, so making sure that it is actually right there beside us in the decision-making process, but made it an advisory function. And the distinction we draw with the advisory function as opposed to a separate capability, if you like, was very much recognising that responsible investment is a change process, and maintaining a level of sophistication in that capability requires a significant investment and a constant upskilling of the team. And so by having an advisory function there whose job it is just really to stay at the forefront of the thinking, bring that strategy and intel back into the team, and then take responsibility for building the team capability constantly across all asset classes in the front office, has worked really well for us.
Corin, again, different approach, different organisation, different approach to skills and capabilities?
Yes, given it's a manager of managers structure, the focus will be on the manager selection process and their engagement. And so part of that would be us understanding exactly the question that you asked, Richard, what's going on the ground in terms of resources, capabilities, but more importantly, the integration of those functions into the decision-making. So what you have seen historically is ESG functions or ESG teams. This is at the corporate level, this could be at the manager level, but it's the integration of those functions, looking at whether or not KPIs at the right levels in organisations and fund managers also involve the ESG function and the climate change. That's the focus we have. As a team, we're also growing our own internal. We have a dedicated function, which is ESG on manager due diligence, which is, again, separate to the fundamental bottom due diligence that's done by most of the asset class teams. And the challenge is, again, even with ourselves, is to bring those two together.
Mm-hmm. Damien, I might grab a microphone. We talk a lot about climate risk, but is climate change an investment risk or is it an investment opportunity? And if it's both, which I'm assuming you probably will say it is, are we allocating resources appropriately to both sides of that discussion?
It is both. But I can only speak on behalf of ourselves. We most definitely are. And it's probably worth just sort of using one of our assets as a bit of a case study, right? So it would be a fairly courageous organisation if you've got one eye fixed on trying to sort of get to a zero carbon sort of outcome to go and buy the third largest beef business in Australia. With a feedlot, with 220,000 head of cattle scattered from the Northern Territory down to the southeast corner of Queensland. So it'd be a fairly courageous organisation, I'm sure most would agree, if that's what you were trying to do. Well, we indeed did that. Either courageous or very stupid, one of the two. But the point I want to make around that is that we identified that asset clearly, from an investment outcome perspective and a diversification perspective for that large client that we were acting on behalf of. But we also saw that we could take a leadership position in that business in terms of how we could potentially make that a business that had a fairly gutsy objective of trying to make that business a zero carbon emitter by a particular date, which we have indeed done. It's a fairly gutsy call. It's sort of 2025, we'd like to get there. You're probably sitting there thinking, that's going to be interesting, how are you going to do that? But the point I want to make is that QIC is the sort of the corporate, the organisation, is working really closely through Kate and her team, and Andrew Saunders particularly is working almost daily over at NAPCO, trying to work through how we potentially get there and how we get there. And I think the point around that is that most people would look at that and go, that is a massive risk. Why would you do that? We saw that as indeed an opportunity. And the returns on that asset, whilst quite variable, because there's a lot of dependencies in agriculture that don't beset other asset classes, as we all know and we all appreciate, and we obviously put a risk around that and we put a value on that risk. But I think the important point is that we've identified that as an asset, as an example where we could potentially be at the forefront and express indeed a leadership position. The infrastructure portfolio, the real estate portfolio, we're a large emitter currently in our real estate portfolio. When you think about what that is, it's a $22 billion real estate portfolio that is dominated by retail shopping malls. Clearly, large emit. You've got to think that those assets, do emit. So we also want to try and get there, in a fairly aggressive manner as well, and we've already started that pathway. There's a fine line between the challenge and the opportunity, and we believe that as long as you can price that in and you can get paid for that, is most definitely something worth having a go at.
I'm interested in the others on the panel as well, just to comment on that, just in terms of risk or opportunity or both, and how do you balance the two, I guess would be fair to say.
Look, as a CIO, I think I'd be in a lot of trouble if I ever answered a question on risks or opportunities without having the two together. So, you know, at an asset level, it's a combination of both, and that's the how to make an investment decision 101. If you're an oil and gas exploration firm, you know, probably there's more risk than opportunity, and so managing the potential risks that you face when making large capital investments is the forefront of what's occupying your mind and what's occupying our minds when we're investing in organisations like that. If you're doing dedicated investments into renewable energies, then you might be seeing that as more of an opportunity. But I think the session before this really highlighted that all these things together need to be something that's a total fund approach, and so you bring all the different risks and all the different opportunities together and ask yourself whether or not you're making an impact.
Sonia?
Yeah, I would completely agree. I think the risk side is still evolving. There are still data challenges. So to really deeply understand the risks, and by risks I mean the physical risks and the transition risks and the potential legal risks, in addition to, you know, the obvious stranded asset risks, is still challenging. I think the opportunities, even though, you know, we've invested into renewables and we've tried to be, you know, facilitation capital into the transition, even that market is challenging. So, you know, I think you've got to have really strong underwriting capability to make sure that you're making good investments. And as we saw earlier, you know, this is still challenging. So I think there's a lot of investors like us that really want to step forward and take advantage of these opportunities. But just finding a way to do that effectively. At the moment, we still do most of our opportunities within asset classes. And again, we're having very similar conversations to what we saw here today about, you know, really, is that the best way to attack this problem? Or should we be, you know, almost targeting deliberate climate transition allocations to try and really, you know, really further encourage the team to actively seek out capital deployment into these strategies? So, yeah, it's an active discussion.
Yeah, Corin.
Just, you'd think it's an opportunity for active management.
Thanks for that intro, Corin. Well, I was going to say something. I was just sort of reflecting when Damien was talking that my understanding, and I believe there's a lot of research to support this, that the bulk of a lot of the research around added value through putting an ESG lens on things comes around actually anticipating change. So that's what active management tries to do, is anticipate what's changing. And so rather than having a screened portfolio where, you know, you don't own the bad stuff and you only own the good stuff, a lot of the potential returns and improvement more broadly, more impactfully for us as a society comes from businesses changing their practices and changing the way they run things. And so being able to identify those businesses, like, you know, and being actually proactive within those businesses in helping to create change, whether that's through engagement or direct ownership, huge opportunity. So it's not just about renewables, it's actually about how organisations evolve and improve, and that's where there is significant potential from an investment perspective.
I think we also, in the last session we heard it a lot before, we're also seeing it quite a lot in public conversation at the moment around the question of engagement and active engagement with companies in particular. You know, is that part of that opportunity or risk discussion when you're engaging with a company? And is there more that investors could and should be doing in terms of the conversations that they're having with companies in their portfolios at the moment? Open question.
Well, I can talk in the context of our participation in the Climate 100 plus action, and I think that definitely falls into the opportunity category in my mind. Just sitting in front of senior management of organisations that are systematic emitters, high-level systematic emitters of CO2, and getting them to realise that the engagement from the likes of asset owners and stewards, as we like to think of ourselves, is about financial risk. We're not trying to disrupt their business model. We're trying to get them to understand that we're trying to make investment decisions. We're trying to weigh the alternatives that are in front of us, and that if they engage with groups like Climate 100 and just with asset owners in general, and improve their disclosures and improve the quality of their discussions with investors, that is upside on both sides.
Mm. Richard, did you want to jump in this one?
It's hard to I don't know which way, but anyway, it's critically important. This whole the role that, whether it's a superannuation fund or whether it's an active fund manager or whether it's a group like Regnan or IGCC, the importance of engagement is absolutely critical, and doing it in that positive way that you were just alluding to around we understand your business, we actually want a sustainable evolution. We want sustainable earnings and economic growth. These are the things we want. You look at this is a real example of a lot of the companies that we own that are heavily dependent on exports, who are heavily dependent on ports that they own, and sea levels are rising. What does that mean? What are you doing about it? These are real discussions that we have every day with companies, and unfortunately in some cases they're too preoccupied by what things are looking like and dealing with the PR around things to actually get back to focusing on what do they need to do as a business to actually deal with these transition risks and these very, very real physical risks that they're exposed to. So most definitely it is an important leg of the stool, and of course only one of others. So whether it be communal engagement like Climate 100, or whether it be other sorts of shareholder activism, they all play a role in making sure that management knows how important this is to us on behalf of the beneficial owners. One last point though I wouldn't mind making, which is that I was talking recently to a friend of mine who runs a funds management business, and a company chairman came to him to say, look, I love coming here to talk to you about my business strategy. And if I need capital, I can come and get your perspectives on things, and you understand the business. And in fact, I love talking to all my shareholders. The problem is that so often now they're just algorithms and they don't return my call. And it's an interesting one because this was, he was making light of it, but it was a very real joke or very real issue that increasingly so much of our stock is held through passive or algorithmic strategies. I'm not saying that's good or bad, I'm just saying that it doesn't play the same role in dialogue with a company that otherwise might.
Damien and then Corin, I might ask you both to respond to that. In terms of engagement versus algorithms.
All of the above.
Or the above.
No, again, I think Michael Trail made a really good point on that panel earlier. I only caught a bit of it, but I didn't catch that point that Michael made around what does good look like. And there's a distinct lack of sort of benchmarking that's sort of been sort of evolved or built around some of these issues. And, as managers and people who are competing for people's trust and competing for capital, we in our normal world, we've got benchmarks, and usually the client sets a target against that benchmark for us to achieve. Whereas in this space, there's no real benchmark at this point, and I think there's still a degree and a high level of sort of subjectivity around what good looks like. So I think we need to really try and build that out over time, because I think that's a very important way of holding people like us to account and being able to obviously justify what we do. And I think that's a really sort of the next iteration, hopefully, of the debate will be around what are these benchmarks that we should be sort of aspiring to.
Corin, did you want to pick up on that as well?
Well, I guess the difference in active versus passive with respect to the question is one is backward-looking and one is forward-looking. And if you're investing capital on behalf of other people, that I think will be part of the question you ask yourself. Ultimately, the passive investing will get you a result, but it'll be after the fact.
Okay. Sonia. Yeah.
So I was just going to say, just on that, what does good look like? I think it's a real problem, and one of the things we've done is come up with a framework for each of our asset classes on what good looks like to us, and then we've rated all of our external managers against that criteria, and then we fed back to them where they scored and where they scored versus the average manager and the range of outcomes to try and create a bit of competitiveness and to try and feed back information. And to say to people, if you stay, at the lower end, then you probably won't be staying as the manager. So it's trying to motivate people to lift to the standard that the market is moving to, and recognising that they've got to invest to stay relevant.
But that also treats them as real partners, and of course that's another element here is, the value chain between a company that's doing something, making widgets or whatever, and ultimately the end member for whom we all work. There's about 8 or 9 levels of that value chain, and we need to ensure that for this sort of mission, which is of course critical both to returns but also the broader ecosystem, which is of course critical to returns, again, that we actually manage effectively through that value chain in partnership.
Well, I am going to open up for questions from the audience, so please put your hand up in the air and just signal if you'd like a microphone. And while someone is finding you in terms of the audience, I will just ask one further question. We've got one down there. I would just ask one further question of everyone on the panel. We talk a lot about the organisational responses to date. We also talk a lot about the urgency and where we're tracking. Is it fair to say that the industry as a whole should be doing more, could be doing more in terms of actually stepping up ambition in terms of climate change? That's somewhat of a Dorothy Dixer, but is there more room for growth here? Should we be moving faster, I guess is also a question, or is it a question of moving at the pace that's appropriate?
Or it'll be brave and have a go. I think clearly we can do more, and in this particular space, there is so much more to do, right? I think Sonia alluded to the fact that there is just issues with data, there's issues with scenario analysis, the range of potential outcomes are huge. It's very difficult to work out what to do, and so there's lots of work to be done. In terms of urgency, there's probably not that many people in this room that wouldn't agree that dealing with climate change is a very serious topic, and so I think both of those are true.
Yeah, I agree. I think there is still a lot to do. I think there's a lot more we can do. I think like anything, it's trying to balance that with, I guess, the financial outcome, and I say that very, very cautiously. But there's a capex. There's a fairly substantial capex demand on legacy assets, as an example, that you will need to make to get those to a position. And I'm only talking about it from our perspective here as an active manager of real assets. So there is there's a capex conversation that needs to happen. And then there's an OPEX conversation that needs to happen as well. I guess, but deploying capital is quite different. Deploying new capital. So there's 2 bits for us: is transforming a legacy, a legacy book of assets, which we are doing a lot on, in consort with the ultimate owners of those assets being the large funds. But still trying to generate a suitable return, financial return for them at the same time. But then there's new capital, and where we're deploying that, as an example, We raised a $2.5 billion global infrastructure fund, which we closed out about 18 months ago, and 30% of that capital has found its way to what you would easily term as hardcore sort of renewable assets. Wind and solar primarily, and distributed energy. So for us, there's two bits to it. It's how you deal with the legacy stuff, and then how you deal with, and where you are deploying that new capital.
Yep. Okay. We had a question down there. Just.
Hi, it's Zoe from Citi. I just wanted to ask, we've on this panel and on previous panels as well, there's been, I think, just this constant echo about manager integration, but also about the strength of engagement and how promising it is to kind of engage with companies and get this improved performance. And obviously, asset owners in particular have an impact on not just their on the market, not just through their own strategy and direction, but also through the influence and the impetus that they give their own managers. But this is also through the constraints that asset owners might place on their managers as well, performance constraints, whatever it happens to be. And so I guess my question is, does this strategic push towards engagement and towards integration on the manager level also suggest the need to reconsider some mandate terms? I'm thinking particularly performance timelines. And I put that forward as a question. The answer doesn't have to be yes. And I don't mean to make this about necessarily being a trade-off, because it's not a trade-off. But at the same time, I don't know to what extent our industry uses the idea that there is no trade-off as an excuse not to get more sophisticated about the thinking between the rest of the mandate terms and their impact on the wider market.
I'll have a very quick stab at it, and these learned people on my left here are probably far better equipped to answer it than me, but I think it's about alignment, and it's really around, I think the point was made before about partnership, and working closely with your client, as an example, in a segregated account or a bunch of clients in a commingled account or fund is critical, because if there's misalignment around objectives, I think you've got to think it's almost doomed. So there needs to be sort of alignment and solid alignment between the client and the manager, and I think that does give rise to thinking through and reworking the IMA.
So I think it's a fantastic question. In any forum over since I've been in this business, there's been the issue of short-termism, right? Coming all the way.
I was about to ask that, actually.
Right, so and then you look at this particular topic, and is there anything more long-term and anything more serious than climate change? And so putting those two together really is a big misfit, and it does require us to rethink.
Very polite panel.
I would agree. So as a long horizon capital, we obviously have exposure to climate risk naturally embedded in our portfolio. And so the question is, how do we manage it? And we've been engaging with some of our active managers. I think one of the challenges we face is managers say, we're happy to bring down our carbon footprint. Just give us a different benchmark. Just give us a benchmark that's has a lower carbon strategy, and then we'll actively manage around that. Now, the problem with that approach is obviously that then the managers aren't actively engaging with corporates to reduce carbon. We want them as our agents to be out there pushing corporates to bring down aggregate carbon emissions in the economy, in the real economy. And so we're about to go out on a research project basically to engage with our global managers, asking them how they would approach this with the objectives that we have, which is really to change their behaviours and to build that alignment. And ultimately it's got a link to incentives, it's got a link to fees. So how do we link financial performance with climate performance and link that to financial outcome? So any active managers in the room, please feel free to send us your thoughts.
Richard?
I'm just trying to think what I could say to add to that, because I think they're all really, really valid points. I think in particular, just picking up on what Sonia was saying though, reporting, I suppose, the nature of that relationship, how the dialogue goes between manager and asset owner, how that alignment is created and maintained over time. How there's a shared understanding of what the purpose is and what the mission is and what everyone's trying to achieve, which I don't think is always the case, but is actually critically important. And I think if you get that right, you can deal with some of these short-termist issues, which are still very real. And there's lots of evidence that managers get hired and fired at the wrong times, and that's a broader issue, as Colin said, that we need to deal with. But I think the way around it is through dialogue, alignment, and the nature of partnership.
Well, I think we've got time for one more question, just down the back corner over there. Oh, sorry.
Thanks, Emma. Jeremy Burke from Impact Investment Group. We've seen great progress in Australia around investing in renewables, but we are unequivocally over an investment cliff now, pretending that we're Roadrunner and not looking down. So my question, as a renewables investor, do Australian institutions take a kind of negative view towards new risks as opposed to their legacy risks? We started to touch on it, but more specifically, we're happy to take an industry or a kind of neutral weighting to oil, gas and fossil fuels. The history suggests, particularly in Europe, where 500 billion euros was lost and they had to split their utilities into good and bad. Should we be taking more risk in a considered way to decarbonise our portfolios so that in 15 years, 20 years, 30 years, when many of us retire, we can actually look back and say, I'm glad I made the right decisions, not the right risk-weighted decisions under an old way of looking at things?
That's a great
Look, again, coming back to this universal ownership concept, I think there is an opportunity for capital providers, society, governments to work together to really come up with a holistic approach to managing these risks. There's potentially a cost of transition, but there's also opportunity of that transition. And I think if you can get the balance right and get all stakeholders involved and in discussions for the transition, I think there's opportunity there. I think we've seen some wonderful examples of just transitions in mining in Europe, where entire coal mines have been closed down, and we've seen the cost of those being managed. We've seen labour transition effectively into new industry, and we've seen it managed at a higher level than any individual company. And I just think that's a really interesting idea that requires stakeholders basically with a strong purpose to get together and try and solve some of these really big issues.
Does anyone else want to pick up on that collaborative approach as well?
I think it's a really good question, actually, because there's no question that our industry has been trained to think a certain way, and all the skills. This is an issue with impact broadly, and externalities, non-financial factors, all these sorts of things. We don't have clear ways to measure them, and we certainly don't have skill sets that have been built up over many years of trying to understand their nuances and how to value them and consider those risks. And so with a lot of disruptive risks, you could make the same argument around technology or anything else that's disrupting old ways of doing things. I think, it is a struggle for people that have been brought up in a certain way with a certain framework and way of understanding to actually fully, adapt to different things. And of course, in the face of a lot of political uncertainty, that is something that puts asset owners off investing heavily in that sort of space. Of course, that political uncertainty exists on the oil side as well, on the fossil fuel side. So you could argue both ways. It's just that one we're a bit more comfortable than the other. So I think that's the truth. But I think to Sonia's point, increasingly as asset owners become mindful that they are universal owners and that they are exposed to the broad ecosystem risk, they're going to be, as they already are, pushing themselves further and further, and you're seeing it in flows, you're seeing it in the investments that are being made, pushing themselves further and further into dealing with how they're going to manage those risks at a whole of portfolio level. And all of this will come into play there. Engagement, renewables, balancing out old and new through it, trying to push for a just transition. And of course what we haven't talked about yet, which is policy and how critical that is.
Funny you should mention that, because I was just about to ask, because it sounds to me like investors are now managing for a disorderly transition. Is that the case in terms of putting in place the internal approach, strategy, resources, products, services, engagement approaches that are actively aimed at managing for lack of clear policy settings? Should I take myself as a comment?
Just to finish off on that, I think where you categorise, and the lines are getting blurred in portfolios, I think, between infrastructure and private equity as an example. There's a fair bit of grey that exists between those two asset classes at the moment. And I think renewables and greenfield renewables, or new renewables, where you are effectively potentially taking more risk, how you categorise and where they get categorised in a portfolio, commensurate to the sort of risk that is applied to those opportunities, I think is an important thing that probably is worth sort of understanding and fleshing out a bit more. But to your point about policy settings, and I guess the big one at the moment is energy and energy pricing, and the security of supply versus the affordability and the transition and all those sorts of things. There is no lack of capital wanting to find a home in renewables in this country, I don't think. I think where the problem exists is around the policy and who's going to build the line, the transmission line from those renewable opportunities and those assets into the grid, seemingly. And there is a stalemate that is happening currently right across the country in terms of whose responsibility and when does that happen, and who pays for that, which, and that's one that we're dealing with currently on a couple of those renewable assets I referenced before. And different persuasions of governments, unfortunately, have different perspectives around energy policy, and that's the big challenge. But there is absolutely, I don't know whether these people on my left would disagree, but there's no shortage of money to find a home in renewables in this country, from what I can gather. If there was more around and we could do them, we would, as long as we had certainty around what the financial outcome of those were going to be. And one of the key ingredients of a financial outcome from those assets are how you actually connect it into the main grid.
Does anyone else want to comment on that question? Potential hierarchy of preference when it comes to energy generation investment? No, all right. Well, luckily we are out of time. So what I would just say is that I think you're hearing from 4 quite different investors on different approaches to managing for the same set of issues in terms of climate risk and also opportunity, and also looking at this question of how do you build the internal capacity, internal resources, and the different approaches and the challenges being shared. So I hope you'll join me in thanking the panel for what I think was a really interesting and frank conversation. So please join me in thanking the panel. Thanks.